After more than a year and a half since the beginning of this crisis, we see how the stock markets of most of the world are at record highs. However, the reality of the economies goes through a very different situation, with many sectors such as leisure and tourism in times of huge losses and uncertainty. After all this, and after a large part of the population already has protection, it seems that the limitations and restrictions will not cease, as we see in most of the cities of Europe, where there is already talk of a delay in the normalization and reopening of the economies. In this video, we will update the situation of the stock markets and the economy, and we will see what impacts can have a delay in the economic reopening, as well as see which sectors can be the most interesting to generate investment opportunities. Let's start by talking briefly about the macroeconomic situation. For several months now, the market has been in a complacency mode. Most stock markets around the world, such as the S&P 500 and the Nasdaq, are at record highs, and at the same time the US 10-year bond is offering a yield of only 1.28%. In fact, if we subtract the yield offered by the S&P 500 calculated as the inverse of the PE from the yield of the 10-year US bond, we find that this result is at an 11-year low, levels only reached during the Great Financial Crisis. In this aspect, the situation has not changed too much, and the main problem remains the same. If the inflation forecast by the main central banks is not transitory as estimated, but permanent and with levels above 4 to 5%, this would lead to immediate action by the central banks, which would raise interest rates aggressively and earlier than the market expects. The increase in interest rates has a direct negative effect on the stock markets and a positive effect on fixed income, since when bond yields rise, capital usually leaves the stock market or equities en masse and seeks refuge in a safer and more predictable asset such as bonds. However, we already knew all this, and we should include it in our portfolio management on a permanent basis. However, there is a greater concern today that could lead to opportunities, but also to stock market dislocations. It seems that it is no longer a surprise that the delay in the reopening of the world economy is moving from a possibility to a fact. Many countries are increasing restrictions due to the dangerous evolution of the new form of the disease, even though the percentage of protected population is quite high in regions such as North America or Europe. One of the best ways to see and understand this situation is to use the Peter Lynch method, which is to visit companies and countries on our own. In the last few weeks, I have been able to travel around Europe and realize that the economic and social situation is far from normalized. In large cities such as Rome, many of their businesses have gone bankrupt, and other large international firms have disinvested and disappeared from the city with no plans to return. To this we must add the continuous and recent social restrictions that only discourage the arrival of tourists to these cities and delay the economic recovery. Undoubtedly, the times of recovery seem to be set by this disease and not by the severe performance of countries. The market has already realized this and is getting ahead of itself by trying to predict the future of some sectors such as airlines, hotels and cruises. These sectors as a whole are in a new bear market, with declines of more than 20% in just a few months. Looking at one of the big players in the sector, Airbnb, the company has fallen 27% over the same period. Undoubtedly, this delay in the reopening of the economy could affect other sectors, especially cyclical sectors. Some of these sectors would be mainly retailers and automotive, real estate, materials, or even the energy sector. In my opinion, the tourism sector may be one of the best investment options if this strong correction continues, as it is full of excellent companies with very good management. However, it is also possible that you will find value in all the sectors that I have mentioned and that are prone to be affected. But don't forget that, as intelligent investors, our job right now, rather than trying to generate high returns, is to protect our capital in a market that is trading at a very demanding valuation. Do not overpay for any company, try to look for quality businesses with a solid balance sheet and that generate a lot of cash. If you follow these simple steps and think long term, I guarantee that you will not have any problems whatever happens in the market.